Most people think of long-term and short-term rentals as versions of the same thing, a property that generates rental income, one with longer leases, one with shorter stays. The difference feels like a choice about income levels. Short-term produces more, long-term produces less, and the decision comes down to how much effort you're willing to put in for how much return. That framing misses the structural difference between the two models. They're not the same asset class operating at different income levels. They're two different businesses that happen to involve the same physical asset. The first structural difference is the cost base. A long-term rental has a predictable cost structure: mortgage, insurance, property taxes, maintenance reserves, management fees. These costs are relatively stable. They don't change dramatically month to month. They can be budgeted against with reasonable confidence. A short-term rental has a different cost base entirely: furnishing and staging, platform fees on every booking, cleaning between every stay, higher insurance requirements, ongoing restocking of consumables, more frequent maintenance from higher turnover, professional photography, dynamic pricing management. The cost base is significantly higher and significantly more variable, which means the revenue number on a short-term rental cannot be compared directly to the revenue number on a long-term rental without understanding what each of those revenues costs to produce. The second structural difference is volatility. A long-term rental produces income through a lease agreement. A tenant commits to a term. The income is contractually established. Vacancy is episodic. It happens between leases, not continuously throughout the year. A short-term rental produces income through individual bookings. No contractual commitment beyond the stay. Occupancy fluctuates with seasons, with platform algorithm changes, with local competition, with broader travel patterns. A long-term rental in a stable market produces predictable income. A short-term rental in a strong market produces variable income, high in peak periods, potentially much lower in off-peak ones. And the financial planning required for each model reflects that difference in volatility. A long-term rental can be modeled with reasonable confidence 12 months out. A short-term rental cannot. The third structural difference is the relationship to the owner's time. A long-term rental, with professional management, can be operated with minimal owner involvement. The management company handles tenant communication, maintenance coordination, lease renewals. The owner's role is oversight, not daily operation. A short-term rental is fundamentally different. Even with a co-host or property manager, the operational complexity is higher. More bookings to coordinate, more guest communication, more turnovers to manage, more issues that require immediate response because the guest is there for 3 nights and expects hotel-level responsiveness. A short-term rental is closer to running a business than to owning an asset, which is not inherently wrong, but it is structurally different from what most people imagine when they think about real estate as an investment. These structural differences, cost base, volatility, operational demand, don't make short-term rentals inferior. They make them different. And different structures produce different outcomes over time, not better or worse in absolute terms, better or worse relative to what a specific investor is actually trying to build and what they're actually willing to operate. Most people choose between these models based on the income number they see at the top, without examining the cost base underneath, without accounting for the volatility, without honestly assessing the operational commitment each requires. The income number is real. The structure underneath it is what determines the actual outcome. If this made sense to you, you already understand more than most people do. This channel exists for that kind of awareness. Like the video, subscribe, Nothing here is accidental. Short-term rentals can produce significant revenue in strong markets, in peak seasons, with the right property in the right location. The revenue numbers are real. They're compelling. They're what gets highlighted in the content, the case studies, the examples that circulate about short-term rental income. But revenue and wealth are not the same thing, and the gap between them is where most short-term rental investors discover the model didn't produce what they expected. Wealth in real estate is built through a specific set of mechanisms: equity accumulation, appreciation over time, debt paydown through consistent mortgage service, cash flow that compounds into other positions. These mechanisms work across both rental models, but they work differently because the cash flow available to compound, the debt service consistency, and the operational overhead that reduces net return are all different between the two structures. A short-term rental that produces twice the gross revenue of a long-term rental might produce a similar or lower net return after platform fees, cleaning, furnishing, insurance, management, and higher maintenance, because the cost base is proportionally higher. And a net return that looks similar on paper is not the same as a net return that behaves similarly over time. The volatility of short-term income creates a specific wealth-building problem. Compounding requires consistency. Capital that stays in a position and compounds continuously produces different outcomes than capital that arrives irregularly, high in peak months, low in off-peak ones, and needs to be managed against a cost base that doesn't fluctuate at the same rate as the income. In slow months, when bookings are down, the mortgage still comes due. The insurance still comes due. The platform fees still apply to the bookings that did arrive, which means the cash reserves that would otherwise be compounding get consumed covering the cost base during the periods when income dips. And what gets deployed into wealth building is what's left after the volatile income has covered the volatile costs. In strong markets and strong seasons, that can be significant. In weak markets or off-peak periods, it can be very little, or nothing. There's a second wealth-building problem specific to short-term rentals: regulatory risk. Short-term rental markets are subject to local regulation in a way that long-term rentals are not. Cities have restricted short-term rentals. Neighborhoods have banned them. HOAs have prohibited them. Zoning changes have eliminated what was a viable short-term market in the time between acquisition and stabilization. A long-term rental's income is not subject to the same regulatory risk. The lease structure, the tenant rights framework, the landlord-tenant law, these are stable and established. A short-term rental's income model can be legislated away without the asset itself being affected, which means the valuation, which was based on short-term income, doesn't survive the regulation, and the investor is left with an asset valued for one model that can no longer operate that model. None of this means short-term rentals don't build wealth. Some do, significantly, in the right markets, with the right properties, with the right operational approach. But the path is narrower than the revenue numbers suggest, and the investors who treat short-term rental revenue as equivalent to long-term rental wealth accumulation, without accounting for the cost base, the volatility, the operational demand, and the regulatory risk, often discover at year 5 or year 7 that the revenue was real, but the wealth position didn't develop the way the income implied it would. The 10-year financial picture of a long-term rental and a short-term rental in the same property rarely looks the way the year 1 comparison suggests. Year 1. The short-term rental often wins on revenue, sometimes significantly. Year 10. The picture is more complex, and for many investors, not what they expected when they chose the short-term model. What a long-term rental builds over 10 years: consistent debt paydown, every mortgage payment reducing the loan balance, equity building quietly, month after month, whether the market appreciates or not. Stable cash flow, predictable, budgetable, available to deploy into other positions rather than held in reserve against income volatility. Market appreciation on a fully leveraged position, the equity amplified because the debt is serviced by the tenant's rent, not by the owner's capital. And a scalable model. Each long-term rental added to the portfolio operates on a similar structure. The management complexity doesn't grow exponentially with scale. 10 years of that, consistently executed, produces a compounding equity position that looks very different from where it started. What a short-term rental builds over 10 years: higher gross revenue, in years where the market cooperates. Higher operational complexity across all 10 years. Higher sensitivity to market shifts, platform algorithm changes, local competition increases, regulatory environment changes. A wealth position that depends on continued strong occupancy to sustain itself, rather than a position that compounds through structural mechanisms independent of market conditions. And a scalability challenge, because the operational complexity of short-term rentals grows more than proportionally with scale. Two properties aren't twice as complex as one. They're often 3 or 4 times as complex, because the guest-facing operational demands don't systematize as cleanly as long-term rental management does. This doesn't mean long-term is always right. Markets exist where short-term rental income is so significantly above long-term income and where the cost base is manageable relative to that income that the short-term model produces superior wealth outcomes. Those markets exist. They're real. But they're specific. They require the right property in the right location with the right regulatory environment and the right operational approach. The long-term model is more broadly applicable, more predictable, more scalable, more aligned with how real estate has historically built wealth, through equity accumulation, appreciation, and consistent cash flow over long holding periods. Most people choose between these models based on the income number. Short-term shows more at the top, so short-term gets chosen, without working through what the cost base reduces it to, without stress testing the income through a slow season, without modeling what 10 years of each structure actually produces in equity and deployable cash flow. The revenue number is compelling. The structural analysis is more complex, and most people stop before they reach the structural analysis, which is where the actual decision about which model fits a specific financial position and a specific set of goals actually gets made. If this shifted something for you, subscribe. Like this if it clarified something.